So when my dad and I would watch Bonanza when I was a little boy, they had an car air filter commercial, and the guy would say, well, you can pay me now or you can pay me later. And that's really the question that comes before us today is in the tax situation. We can pay now knowing what the tax rates are and try to manage a big tax hit today, or we can wait and pay later when we don't know what the tax rates are going to be in the future.
Hello, everybody, and welcome back to episode number 2 of the Sleep Well Financial Show. I know.
The crowd goes wild.
The haters said we couldn't do it, and yet here we are.
We are on a roll. Wait, people are saying, hey, wait a minute. They're wearing the same clothes they were last week.
We don't have a wardrobe budget yet. But my name is Josh Hinojosa, and I'm an independent advisor representative for SWAN DFW. That stands for Sleep Well at Night, Dallas-Fort Worth. And across from me is Hector Hinojosa, who is a certified financial planner, which is the top mark in our industry.
That's right. Glad to be here. Glad you're here.
So last episode was episode 1 on taxes. And so if math is your thing, this will be the second episode. And next week will be the third episode.
Oh, that's very good.
Yes, I know. So you can pay me now, you can pay me later. A lot of our money as a country is in tax-deferred accounts. And we're going to talk about what that means and what that is. But I believe you wanted to start with the story of a former president.
Yes. My favorite president, the first president I ever voted for, Ronald Reagan. Before he became a politician, he was an actor. In the 50s. Tax rates back then were 94%. And that's for people that made over $200,000 a year. Well, he made $100,000 a picture. For every movie he made, he got paid $100,000. So he would make 2 movies a year. Because then after that, it really didn't pay for him to make more movies because 94% of the next picture would go to federal taxes. And the other 6% would, because he lived in California, would go to state taxes. So it really didn't pay to do taxes. Now he eventually becomes a politician and did a good job of raising revenue, but sadly Congress didn't do a very good job of cutting spending. And so, anyway, that's one of my favorite stories about Ronald Reagan.
Yeah. So he was like, hey, taxes are too high.
That's right.
And I think a lot of people today are like, taxes are too high. But when Reagan thought taxes were too high, the top marginal tax bracket, as Hector just said, was 96%. Is that true?
Yeah.
Today, our top marginal tax bracket, our top earners pay 37%.
Yeah.
Which, again, if you're a math person, that's going to be significantly lower than 96%.
Right. Mm-hmm.
So we think that because of the deficit and a lot of other reasons that we talked about in the last episode, the tax rates are likely going to go up.
Right.
And we have a lot of our money in what are called tax-deferred buckets or tax-deferred accounts.
That's right.
Why is that not a great thing?
Well, first, let's talk about why we have them in there. When 401ks, and that's where more wealth now is held in 401ks. It used to be our homes, and now 401ks hold the most wealth. When 401ks first rolled out, the story was this: look, if you're making $100,000 a year and you put, say, $10,000 into your 401k, you're only going to pay taxes on $90,000. So you didn't, but that's amazing. Yeah, good job. Then you put the money there, and then when you retire, you're going to be making less money than when you were working. So instead of the 20% tax bracket, you're going to retire at, say, the 10 or 12% tax bracket. And so there's an arbitrage. You save 20, you're going to pay 12 when you take it out. It's a great deal.
Yep.
Except for it didn't work quite out. It didn't work quite that way. What's happening in America today is that people are making as much or more money in retirement. And so the tax rates are higher in retirement because you're making more money and you don't have all the deductions that you had while you were working. The kids are gone. And even if they're not gone, after 26, you can't take the deduction anymore. The home interest rate if you have any left is minimal because all the interest was paid up front, and you don't have a 401k anymore because now you're taking money out of it. So even if you're making the same amount of money, you may be paying more in taxes because your deductions are gone. And so sadly, most of the money Americans have today is in these tax deferred 401k and IRA buckets. And we think it's a good time to start thinking about either reducing that and certainly not putting more money into them.
Yes. Because if tax rates go up, right, even if they stay the same, it's probably not ideal for you to have all of that because you're assuming some risk that the government may raise taxes, right? The best case scenario, I think, tax rate wise, is that they stay the same.
Yeah.
Right? That's like absolutely best case. I don't think anybody's hoping for significantly lower taxes.
Well, everybody's hoping for that.
Yeah.
I don't think it's realistic.
Yeah, I don't think it's really feasible. And so by keeping a lot of your money in there, you are exposing yourself, your 20 or 30-year older self, to significant tax rate risk.
That's right.
In the future.
That's right. Like the way this was put, what you have when you enter one of these plans is you take on a partner. And then your partner is the IRS, except that the IRS isn't going to tell you what their share is until sometime down the road. And so right now their share is 22 or 24%. But if taxes go to even what they were in the 70s, and that's not that long ago, I will remind you, that taxes were 70% then. And so if your partner, the IRS, decides that he wants 70% of your money instead of 20%, there's really nothing you can do. When you take $1 out, you're going to have to pay whatever the tax rate is when you take that money out. And the math tells us that it's likely going to be higher and probably going to be significantly higher than it is today.
Yeah. So let's put some numbers on this.
Okay.
Let's say that you are getting $10,000 a month from a qualified account.
Okay.
Okay.
So you're in retirement now.
You're in retirement. You're taking money out of your tax deferred.
I'm getting $10,000
so
a month. That's awesome.
$10,000 a month. And your effective tax rate is 20%.
Yeah.
Once you average everything out, because tax rates work kind of as a cylinder.
Yeah.
You pour money into a cup and it slowly fills up the cup.
Right.
So your first little bit is taxed at the low at 10%, the next is 12, and so on and so forth. When you're at the 24% bracket, that's not all of your money getting taxed at 24%.
That's correct.
That is just that chunk of money that falls into that is taxed at 20. So we'll say your effective tax rate is 20%.
Okay.
When you get your $10,000, 2,000 of those dollars goes to the government. So you're living on $8,000, right?
We call that foldable money. That's take home.
If tax rates were to go to, let's say your effective tax rate goes to 50%, then 5,000 of those dollars are going to the government and 5,000 of those dollars goes to you.
Yeah.
But you, I don't think magically can live on less money. So you're going to have to take more money out and it just compounds and compounds and compounds. And the higher the tax rates go and the higher the amount that you need, the larger the numbers get and the quicker that your accounts draw down. So you want to protect yourself from that.
That's right. To get to the same $8,000 net, now you have to take out $16,000 in your example to pay $8,000, and $16,000 is like way more, almost 60% more.
Yeah.
See that?
Math.
Yeah. And so if you got $1 million portfolio, probably was going to do really well. Well, let's call it a $2 million portfolio. It's probably going to do really well at $10,000 a month. But you start taking $16,000 a month, and that becomes a challenge. And you can do that for a period of time, depending on how the market does. But there may be a time where you just run out of money, just because you do.
Yeah.
So, what we suggest, what we're encouraging our clients to do, is start thinking about moving money out of that bucket. But for our younger clients, if you're still working, stop putting money in that bucket. If you have a Roth IRA, your Roth 401k at your work, use that. The tax deduction that you're getting today on your traditional is probably much lower than the taxes you're going to pay later on. So it's better just to pay the taxes now and put it in a Roth. And That's the first thing. And so if your employer doesn't offer a Roth 401k, perhaps you put as much money as you have to get all the free money, right? Whatever the match is, you want to make sure you get all of that. But then anything after that, perhaps we open Roth IRAs and put money in there. The idea is not to keep building that tax deferred bucket, because we really think that at some time down the road, the taxes are going to be charged on that money coming out, because all of that gets taxed at ordinary income. If tax rates go up, like a lot of people think they will, you're going to end up spending way more in taxes than what you were probably planning to do.
Yeah. So if you would like to talk to Hector or I about this in your own financial plan or financial life, we have a couple different ways that you can contact us. The first way is via phone number, and that is 888-792-6339. Or we have an email address, and that is info@swandfw.net. Both of those will be in the description wherever it is you're watching or listening.
Yeah. Thank you for listening, and we hope to see you next time.
Yep.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.